Hey, bulls and bears. Greetings. It is JJ here with Bull Boom Bear Bust. Back with another dose of economic reality. It is Tuesday, February 18th, and back with another housing market update. This one is a bit overdue. We're tracing home prices here in the US, and we're looking at all the underlying factors that dictate the direction of the housing market, and the direction is still bullish. Not much has changed except for the actual prices. Prices have risen once again, and we're going to talk about that. In over 90% of markets tracked, prices are rising. They're up year over year as we continue to see this economic landscape of keeping the banks operational, keeping the banks liquefied, keeping lending going, combined with the consumer that's very, very confident right now in the economy because of a lot of the numbers that are being floated out there right now by the current administration. Today we're going to look at actual home prices. We have a National Association of Realtors housing chart update. It just was updated here. It's updated quarterly, and we're going to look at the recent update here with the major metropolitan areas. We're going to look at home inventory and how it is much lower this year than it was last year. So we have more people now trying to get financed, trying to buy a home, less institutions and more people and people looking to get into the homes to live in versus investment properties. Okay, we're also going to talk about mortgage rates, home prices, and a lot more. So let's go ahead and get started. We're going to start off right here with this chart. This is out of mortgagenewsdaily.com. If we look to the far right, we see that we are still hovering near 50-year lows. And as you probably know if you've been following the housing market, this is one of the keys to keeping the housing market propped up and keeping prices rising, combined with a confident consumer. Of course, loose lending, and I'm going to talk about lending guidelines that are getting looser as banks are looking to qualify other types of assets as income in order to qualify more people for mortgages. Mortgage applications jumped 5% to almost a 7-year high. And that is a report that came out earlier this month. So we have to ask ourselves, with home prices now beyond where they were in the 2008 housing bubble, why are so many people so confident in the economy and so confident that they can afford these homes, these monthly payments on these overpriced homes? What is driving this? And again, it's a lot of the numbers that are floated out there. If you look at the president and his speeches, he's continually pushing out there how the economy is the greatest of all time. It's the envy of the world. But behind the scenes, what 99.9% of the people do not realize is that it's being propped up via a stimulus and intervention into the banking system. So, in my opinion, it's a very dangerous time to be buying a home right now, especially in some of the bubble markets. In other areas, especially over in the Midwest, it's not that pricey. It's not that inflated as far as the bubbles in certain states like Pennsylvania, Michigan, Illinois, Indiana, Wisconsin, especially in the rural areas. Now, a lot of the cities, even in some of those states, are seeing massive home prices, and even in some cases beyond where they were in 2008. So, where does this lead us to with homes on the market? Inventory is very low compared to a year ago. When we look at a more recent chart here, as of December, we had about 5.7 months of homes on the market, and it did tick up a little bit here seasonally. But when we look at last December, I shouldn't say last December. Last December was 5.7%, December 2019. But a year prior to that, December 2018, months of inventory was 7.4. So year over year, a big decline in homes on the market, further driving up prices because less homes means more people trying to get the same home and get their offer accepted. And we're still seeing multiple offers in most cases in some of the hotter markets. And we're going to talk about specific markets here in a minute. But next, let's look at some lending, let's say creative guidelines. And this is out of the OC Register. And the headline, Mortgage Qualifying Rules Get Creative. Where have we heard that before? Creative lending. Well, that sounds pretty familiar. Isn't that what they called a lot of the loans and mortgages that were given out before the housing bubble went bust about 12 years ago? Remember creative lending, interest-only loans, stated income loans? Well, they're not doing an exact repeat because I think that would put them in the spotlight. The co-headline here, mind-boggling lender guidelines based on borrowers' claimed ability to repay a loan, not income. So what could that be? Well, what they're doing is they're taking people's equity that they have in other properties or property, and they're dividing that by the number of months, and they're counting that as income. So if their income by itself is not enough, they can look at other properties and equity and count it as income. So some lenders are out there now counting this towards income, and it's income that's not taxed because it's really not income, it's just equity, but they're treating it as income. So let's ask ourselves, in a strong economy where wages and salaries justify these home prices, why would they have to keep coming up with these creative ways of getting people into a home or getting people qualified for these mortgages? Now, we've talked about previously on several occasions other ways that they're also getting people qualified for mortgages, including changing the DTI ratios and getting rid of DTI completely is what they would like to do. Believe it or not, there is a push on for that to happen. Also, counting other types of income like gig economy jobs, Uber drivers, Lyft drivers. And think about that. These are 30-year mortgages. Do you know how many things could change in 30 years? A lot could change in 5 years. You could get laid off from your job, you can get sick, or you have to move because of a family situation and have to relocate and try to find a different job. But they're using all these creative ways to get people into these mortgages. And again, not a sign of a strong economy when they have to do this to keep a market propped up, in this case, the housing market. Here is the updated housing market map. This is put out by National Association of Realtors. We're going to link to this. It's embedded over at our website. And let's go ahead and click on it here and look at a few select cities and see some of the bigger price shockers, if you will. Let's start off right down here in my neck of the woods, San Diego, up 4.6% year over year. That's 655,000 median home price right now. Let's look at Las Vegas, up 4.8% year over year, about 309,000 median home price. San Francisco up 3.9%, 990,000 median home price. And this is going to be a big one. A lot of Californians going to Idaho. Boise up 13.7% year over year. Now 300,000 to live in Boise, Idaho median home price. Even over here in the Great Lakes region, we're seeing, let's take a look at South Bend, Indiana. Up 10.9%, 139,500 to live in South Bend. And we're going to read through some of the main points and highlights out of this press release from NAR, that's National Association of Realtors. And again, this is all U.S. home prices. Metro home prices rise in 94% of the metro areas in the fourth quarter 2019. So this is a bull market for housing. 94% of major metropolitan areas prices are up year over year. Now, on a national basis, the median home price is $274,900 according to NAR, and that is up 6.6% from the fourth quarter 2018. So big year-over-year numbers no matter which way you look at it. Select cities and also the whole nation, basically. The 13 areas that witnessed double-digit price growth last quarter included Trenton, New Jersey, up 18.2%. Boise City, Nampa, Idaho, which we just looked at, up 13.7%. Gulfport, Biloxi, Mississippi, up 11.8%. Kingston, New York, up 11.2%. Albuquerque, New Mexico, up 11.1%. And even markets that started to stagnate last year after mortgage rates started ticking up a little bit along with the Fed raising the Fed funds rate, well, those markets are no longer stagnant or falling. They're actually rising. Anaheim, California, up 3.6%. Boulder, Colorado, up 6.4%. Long Beach, California, up 7.2%. Seattle, up 8%. Boston, Cambridge, Massachusetts, up almost 5%. Now, I've spoken to several people recently who agree that homes are way overvalued, but they have decided to go ahead and jump into the housing market because they feel like this could never end. They feel like this economy is going to continue to be propped up with looser lending, low interest rates, quantitative easing slash bank bailout rescue operations. In my area here in San Diego, I choose not to buy at this point because it doesn't make sense from an investor looking to buy a property and then have positive cash flow to be able to rent it out for enough to cover the mortgage. Obviously, if you're a cash buyer, that's not going to be a calculation that you're going to be too worried about. But when you look at the home ownership rate, it's more people purchasing homes to live in versus investors. Investors are backing off now because prices don't make sense from an investor standpoint. And that's why we have all these looser guidelines to get these owner occupants into these homes. And we see people pushing their careers now, or putting their careers ahead of having families. The birth rate is declining. More people choosing not to have kids, and sometimes two people in the household working to get qualified for a mortgage, even with all these loose lending guidelines. So very dangerous time again, in my opinion, in the housing market. Not something that I wish to invest in at this point. But if there is another correction, if and when there's another correction, I should say when, because there will be. It may not seem like it right now because there's a plan right now to keep this economy propped up. And there's two words that sum up the reason why they want to keep this market propped up this year in 2020. Those two words are first term. First term. Right after November, then all bets are off the table for me. I would not doubt if they stop propping up this economy after 2020 for that reason, because it will no longer be the first term. And I think most of you know what I'm talking about. Thanks for watching this update. Housing Bubble 2.0. Hope you're staying above water. And I hope to see you again here soon for another dose of economic reality. Bye for now.